Thank you. So I think the idea is that we understand how PEs operate. What are they looking at it, right? And each of the items they are looking at is what we wanted to bring. Honest answer is I had also not worked enough with PEs in many years. And I think the day I started working with Mahesh, and I think he was the first one who supported us in working with him and with his portfolio. We learned a lot. I think the kind of penetration, the kind of depth they are looking at is very different. It's not a VC model. It's actually deeply engaging. So I wanted to ensure that in this session, we bring the nuances of what they do, what they look at from a company perspective, what they look at in the markets, and how they look at institutional strength, right? Not just the revenue numbers and profitability, but a long-term frameworks of how operators are running the company. So that's what we wanted to bring. So I think with this, I will invite Mahesh to come out here with us. Mahesh runs Amicus. He's a co-founder and partner of Amicus. We have Suhas here. Suhas has been a veteran. I remember meeting him during his HL days. Thank you. In those days, I realized you guys were looking at very different solutions. So from there to here, very different world. And thank you, Mani. You have been on this side and that side. I think moving to a PE side, I think you will give us more perspective on how fintechs actually should be doing it. So I think we have the right panel. Yes, sir. Thank you for joining, and I'm so happy to have you on board. Thank you, guys. Thank you. I think I spoke about it where people are looking at institutional strength. People are, the Ps are also looking very deeply on the leadership quality. I think when we had discussions, this was largely on leadership quality, governance maturity, because we are always worried that what people will do, and resilience, right, long term. So there's also a thought process around what you guys can do post onboarding, right? So maybe we'll start with each one of you, maybe a quick question set. Maybe we'll start this way upfront. Anything which you want to talk about, underwrite factor which you didn't prioritize earlier, any red flag you think is not going to work long term, anything which you want to talk about, what's the first thing you look at in the company before you say, okay, let's proceed?
Yeah, a number of factors, which we incorporate during a due diligence process, but something which I would say has changed over the past 2 to 3 years is a couple of things which we have introduced. One is the degree of maturity from a technology adoption. How production grade the technology architecture is, whether it will scale up to 5x, 10x without adversely impacting risks, reliability, or the unit economics. We also would look for evidence of how deeply embedded is the senior management on adoption of digital and AI. The other factor which we would very strongly look at is the regulatory compliance readiness. Not just SOPs and policies, but whether they map to actual practices, because any failures here would impact reputation, would stall growth, would have an adverse impact on profitability. And one of the red flags which we very closely observe is if it's a hero-driven organization. What we check is whether the business is run on the relationships of a particular individual or one or two individuals. In fact, this would play out if, let's say, the growth is very high, because manual overrides, exceptions are actually the ones doing the work. So these are some of the things which.
I think while you're introducing this or topic, maybe you want to quickly talk about who Kedaara is and what is a high-level thesis you are working on. Because many of you may not know what Kedaara does, right? And when PEs come in, sometimes we evaluate PEs as VCs. They're very different altogether, right? And the size of checks they write is different, right? So maybe you want to quickly talk about that.
So Kedaara is a private equity. It was founded by 3 people, Manish Kejriwal, Nishant Sharma, and Sunish Sharma. They were all in global PE firms earlier. This was founded in 2011. And we focus on 4 sectors: consumer, financial services, technology, and healthcare. And we have about, as of now, $6 billion worth of AUM. So we are not a VC, so our investment would range, a minimum investment size would be between $100 to $200 million. So we look at growth companies,
I repeat, 100 to 100 million is typical checks they sign, right?
Typical, so some of our investments which we have done is fintechs like Perfios, or we have recently done JustPay. We have in consumer Diary Day, we just exited Lenskart, we have Purple, we have in healthcare, we would have Overseas Fertility, Oliva. So we have a range of, so we also have invested a majority control stake in very large tech companies like Impetus, which is purely into data engineering and AI. Or Neuralum, which is into digital data services. So across, we would have about 30 active portfolio companies now. And the way we distinguish ourselves is because capital is just commodity. We don't do financial investments. We have a very strong operating arm. Like me, I oversee tech interventions in across portfolio companies, across sectors. So we have someone for the talent, we have someone for business operations, we have someone for finance. Yeah.
Oh, perfect. Thank you. Thank you. Suhas, you want to share the same perspective a bit about your organization as well?
Sure.
And of course, I had an opportunity to sort of meet some folks from your team. It took me some time to realize how big you are and what kind of investments you do. That we should want to know. And the second factor is when you, again, the same framework, what do you want to underwrite? What do you check? What do you think is right and what do you think is wrong?
I think first to introduce Warburg, we are like Kedaara, a private equity firm, but we are mostly US based. So we are a globally private equity firm. Globally, we have about $70 to $80 billion of assets under management. In India, we have deployed about funds of about $6 billion in about 26 odd companies. We've been in India for quite some time. We've been in India for 30 years now. Some of our early investments were in HDFC Bank. We were early investors in Kotak. We were early investors, and I think one of our most successful investments
in Kotak?
Yeah.
Oh, okay.
And one of our most successful investments was Airtel, actually. When Airtel was in one circle is when we had invested. So we invest across 5 sectors in India: manufacturing, consumer, healthcare, tech and SaaS, and financial services. I saw some of the people who are sort of sponsoring this were either current portfolio companies or past portfolio companies. I saw CAMS here. So CAMS was a portfolio company for us. In financial services, I think we have about, at present, we have about 5 to 6 companies in the financial services sector. We, of course, are early investors in Perfios. Now, of course, it's much bigger. So we've been there with them for quite some time.
2018 is when you invested, I guess, right?
Yes,
I remember that check you
pre-COVID.
wrote 50 million. I was shocked in how they've grown from there.
Yeah, it was pre-COVID, I think. We've been investors in Home First. We've been investors in Avance in education lending. We've been investors in partners with True Home, which is Shriram Housing Finance earlier. Vistar, which is MSME lending, Fusion, which is microfinance. So we pretty much played the full financial services sector in that sense, especially in lending, and gone past lending also, right? In insurance and both general and life, as well as RTAs like CAMS, right? So we have sort of been very heavily focused on the financial services sector in our investment. Like Kedaara, not early stage, we are a growth PE, so we support companies from a growth perspective. So many of our investments are in companies where we think there is significant growth potential. And we've been lucky to have some great partners in the companies itself who have made us and themselves successful. When we look for investment in any particular company, I think like underwriting a loan, we underwrite an investment, so there's a thesis behind it. Of course, there has to be secular tailwinds in the sector. The sector has to be attractive. But beyond that, we look for 3 or 4 factors, right? How good is the leadership and the management team there? Are they people who we can partner with? Is there a matching of minds in terms of ambition and growth? We also look at how good their plan is, the thesis is, and what is the growth opportunity that exists. Are there sectors or lines of business they are not in today, which they can get into because of their inherent strengths? Are there regions where they can expand into? Is there more potential, especially outside financial services, of exporting? Do they have great products? Do they have great processes? What is their secret sauce? So there are a number of factors we look at when we back a company in that sense. And sort of we bring in, of course, the capital, but then we bring in a lot of support in terms of our advisors, our expertise, our network that we think will help the company grow. Yeah.
No, perfect, perfect.
Sometimes there are.
Yeah. We can check.
You want this?
I think sometimes it's, we also come together, like, a couple of portfolio companies, like Avance and Perfios, both Warburg and Kedaara invested. So so we do.
Sone pe swaga, right? Okay, interesting. So, Mahesh, from your perspective, same framework, but I think you operate in a slightly different scale and structure. So, and you also had opportunity to build a VC kind of fund. So, I just want to know thesis behind the firm as well and how it has played out.
Sure. We are much smaller. We are what I call as a growth capital fund or an early growth fund. We manage, 350 million in assets. We typically write checks of between 100 and 250 crores across 5 sectors, which is healthcare, consumer, tech, financial services, and specialty manufacturing. I think apart from evaluating the business in itself, we have a framework called PPT, which is presentation for all of you, but for us, it's really people, process, and technology. So I think we pay a lot of attention to that because scale in the growth stage really comes from these 3. How good is the people? How aligned are we with the management team and the founders? Is the value creation really going to happen from the founder for the founder and the management team going to happen from the investment that we make? Processes, I think a lot of the due diligence that happens is something that gets done in every deal, but we do something in addition to that, what we call as a process diligence, where we actually send some of our industry experts to go in and look at the processes of how from each department to the other data gets handed over or information gets passed on. And I think you learn a lot more in that process over the years than any due diligence process that really gets done. And the third one is we feel that technology today is at the center of what everybody does for 2 reasons. One, it reduces the friction in how products and services are delivered to your customer base, which means that you're able to deliver it to a larger market in the first place. And the second is every time you add a resource today in India, replace a resource, it comes with a 25% inflation that is built in, which means that every incremental resource is actually 25% more expensive than the previous one that you actually had. And the only way you can bridge that gap is when you bring in operating efficiency, and that happens a lot through technology. Now, there are different ways of cutting that. One way is to say, use words like AI, which I think is going to be at the center of what a lot of people do, but I think the maturity cycle of an organization will determine, how you use technology. So I think it's not a one size fits all. I think companies need to step back and assess where they are in the maturity cycle and then adopt tech to solve for or bring efficiency. So I think those are the 3 things that we really look for in addition to evaluating the attractiveness of the business.
Thank you, Mahesh. And honest feedback is that whatever we have seen him operating, he is humble and simple working with the team. And some of the pointers he put across are typically nobody does that. I've not heard and seen in the market. So I think this is very useful to the market because they will grow better when they have right guidance, right? I think maybe I'm going from a just pure framework perspective, Mani. When you're evaluating leadership teams, what is the exact thing you're looking at? And because the point is, it is good. For example, I'll be very honest, when we do events, if the event is very small, everything holds up. Okay, you can manage. This event will not hold up because I'm sitting in front of you as a leader and I have no access to anything. I'm in front of you, right? The structures are different, right? So my worry is, and I'm being very honest, that can I handle, or as an entrepreneur, can I handle a 10x growth, 100x growth? And in terms of complexity, people, price, customer base, right? So what do you look at from your perspective on this side?
Very important question. And as I mentioned, when a PE firm chooses to invest in a particular company, it enters with a certain valuation, with an endeavor and a hope that in some years down the line, the valuation is going to multiply. And one of the aspects, very critical aspects to help us to achieve that is leadership. So this is something which is right on the top when we do the evaluation. And when we evaluate leadership, we look for evidence that ownership and accountability is embedded in the way business is run and not just restricted to one or two individuals. Okay. This aspect gives us confidence that the business will hold up as the growth scales up. Some of the other things we look at very closely, and the due diligence sometimes goes for months together, is let's say the top 4 or 5 which I can name is, one is clear decision rights. Okay, like the various decision levers in a business, have they got owners identified with clear accountability? We look at if there's a cadence, and this I mentioned some time back, a cadence of business reviews with clear actionable points. We look at the culture, whether there's a culture of constructive conflicts, if the people N-1 below the leadership, below the CEO, if they are free to express their views and opinion, which is not necessarily matched with what the CEO says. That is very important. And one of the important things we also check is a single version of truth on numbers. All our decisions, quantifiable decisions, are based on business metrics, where they come from reliable source. We look at consistency when different leaders, when they talk about the same business metric, whether they are talking about the same numbers. Okay, so these are some of the things. We also look at the talent beyond the CEO. Whether how strong the depth and the succession planning of people beyond the CEO, whether they understand the nuances of business, and they're able to speak in the same vein, with the same passion, with the same growth aspirations as the CEO does. So, yeah.
Perfect, thank you. I think a bit of a break, because I think my friend left his mobile here. Let me just return it back here. So, as from your side, when the entities start scaling, there are always patchworks people can do, right? It's like scalability, you will put patches. But how do you see it, saying that it is done properly and so that it will not come back? It can be issues in market entry issues, and you fail and you take wrong direction. So how do you see that at every point of time control comes in without overpowering the founder? Otherwise, founder will say, okay, they're controlling, let them figure out what they want. Anyway, I have a lesser equity on the table, right? So how do you sort of manage that out, the performance momentum?
See, I think to add to what Mani said, right? I mean, the establishing of a leadership in a firm that we invest in is a one-way door. If people understand the concept of a two-way door and decision and a one-way door decision, right? A one-way door decision is a decision you have to stick with for a long time. It's not easy to change. A two-way door is something which you can sort of open and close or come back from, right? So there is a significant amount of time spent in establishing the right leadership and the right culture in the leadership, right? Any thesis we have for the growth is something which is typically always aligned with the leadership. It is not something which we as investors are able to force on the leadership, right? Because the minute you start doing that, it becomes very difficult for them to own the outcome. It then becomes something which has been dictated by the firm that is investing. So any underwriting thesis that we build, any plan that we build is something which is aligned definitely with the CEO, but also beyond the CEO with the leadership in the company. Typically, once we do the investment, within the first 100 days, we chart out what is the plan for the company to execute over the next 2 years, right? And that's a plan which, while we may have a point of view, it's a plan that we get the company leadership to own. And within the leadership, it's not just the CEO who owns it, but individual CXOs own elements of that plan. Then it becomes more of a plan owned and led by them with some support from us, rather than a plan which has been dictated by us. Because it is something which is owned and led by them, there is a higher level of ownership and execution autonomy that they get, right? Typically, because our investment is for over a 5 to 7 year period, a lot of the heavy lifting in establishing the right growth mechanics, establishing the right investments for growth, establishing the right processes, controls happens in the first 2 years. And those 2 years, we work very closely with the leadership owning the change rather than us owning the change. That's how we make sure that they actually are both owning the outcomes, but also owning the plan and have the autonomy to execute.
No, perfect. Thank you. Thank you. Mahesh, from your perspective, what are typically you've seen the biggest constraints in the scale up of these companies, right? When they come in, is it sometimes discipline issues, right? People not taking right calls, right point of time, maybe validation is not there, or they're depending on too much of consensus, and consensus may result in delays. Operating process, which you spoke about that, or maybe just capability. So what typically sort of puts you off saying, ab nahi ye karega, ye nahi kar payega, right? So you typically get put off rather fast, right? I mean, generally we do, right? So what's your take?
We come in a little early in the life cycle of some of these businesses, and if I were to put a stage, maybe say Series B, right? And given that we invest in diverse sectors, it doesn't have to be necessarily have an investor. So we could, in many cases, be the first institutional investor, even though we are coming in many of these businesses. So when you look at some of those businesses, they're typically founder-run or family-owned businesses. And decision-making is really done by the founder. I think everybody around the founder, are ready to say yes to the founder, clap and support him or her. Very rarely do you see dissonance out there. Decision-making at that point in time is mostly what I call as gut-based or intuition. Founder has run the business for a long period of time. He decides, you take a price increase, you take a new market entry, capital allocation. But when we come in, I think most of our decisions are what I would call as a lot more considered with data-driven insights. I'm not saying that you shouldn't take decisions based on gut, but does the decision really have a backing of past data, some trends? So I think a lot of the times when we go in, we have to establish that culture of people really willing to agree or disagree, put a point of view, have an open discussion. So I think review meetings become more structured, data is circulated, everybody works on the same data set, right? And I think at least at the stage that we go in, we find a lot of challenges where different teams are working out, finance is working off a different sheet, sales is working off a different sheet, something is sent in transit, but by the way, finance doesn't count that as a sale. So there's utter chaos. So I think, how do you get everybody onto the same page, make sure that they have access to the same level of data and that decision making, and it's okay to disagree, right? And have a point of view. So I think bringing that culture where people are not afraid to disagree with the founder, put forth their point of view, have greater autonomy to operate, right? Founder a lot of our companies, we see founder checks in 5 times a day with the operating teams on what's really happening, right? So you can't breathe down people's necks. So I think you align outcomes to compensation, bring in maybe ESOPs, equity at that point in time. So I think a lot of that kind of work comes in where we are aligning everybody to a common goal of value creation, right? So which could be in moving from a simply fixed salary compensation to a variable compensation. So I think a lot of that heavy lifting is done, typically when we come in many of these companies. And it's not an easy process, it's frustrating because people feel that they know how to run the business, who are these outsiders who are coming and telling us, we've been doing this for 30 years. We've been doing it pretty well, but somebody is now telling us what we need to do. So it's not easy, but I think we have to build that consensus. The first 6 months is very important. We have to go in there and demonstrate that we are on the same side. We are working towards creating a better organization. And I think one of our biggest highs, apart from the fact that hopefully we'll make money on our investment, is to actually leave the company in a much better position than we inherited it. I don't think there is a better high for a private equity professional or a firm than this. And I think, I can say this for the entire community, and I think all of us feel very, very excited when our companies succeed and they're in a better position than when we inherited it. So,
Just add one more point is, the point what Suhas said is very important, that it has to be aligned with the founder. It's sometimes we do bring in professional CEOs, and sometimes we let the founder run. But whatever it is, the organization structure that is required for an aligned growth plan, that is aligned with the founder, and even before the transaction is signed. So let's say if it is decided that we need to get a professional CEO, that is with the understanding, it's not a surprise or a shock to the founder once the transaction is closed. So I think these aspects are very important. But this leadership is a key to help us to achieve the growth.
No, perfect.
I'd like to add one point. I think philosophically we believe that at least in the businesses that we invest in, we identify the people gaps very upfront. We don't go in and say, you need to change X, Y, Z 3 weeks after we make the investment, because I think our typical hold periods are 4, 5 years, 6 years. And if you're going to have a friction with the founder on managerial positions, you'd rather have it before than go in and waste the next 2 years trying to figure out how you're going to make those changes. So I think those are very important. So there is no surprise element. And I think that the point is, how do you institutionalize the business and processes so that the organization can you can remove friction. And I think one of the biggest things that we help our founders understand is that the senior management's role is, apart from running the business, is to act as enablers and remove friction in the entire running process. And I think helping them understand that is half the battle won, actually.
No, perfect. I think we spoke about you leave the company better than what it was. Maybe, Mani, you want to talk about how do you get engaged, what layers you get engaged from a tech business, hiring, how do you, so because VCs don't operate early stage, do help to some extent, which is personal level interventions, but Ps work differently. So how do they support, what are the levers you would apply, and you leave it at the better stage than they were in?
I think it's multiple. Quite a bit of it was spoken now. It's multi-pronged. It's not just one aspect. The first 90 days are very important to bring the operating cadence of operations review, which would help us to. It forces clarity on ownerships. Brings about issues which are existing, the gaps which are there in various aspects, whether it is product, whether it is cost, whether it's sales, whether it's market, the improvement areas that needs to be put in place. We would also look at, and Mahesh just alluded to that, the org structure that needs to be in place to help us to achieve that goal, the type of leadership teams that needs to be hired. So we are very strong on helping the portfolio companies on the operating side also. So we help them to identify the talent, help them to put the structure in place, help them in terms of onboarding the talent which we recruit, whether it is at the C level or at the managerial level. We help them to settle down and make sure that they are well set in the organization. We look at cost levers. Anything and everything that impacts cost, because cost impacts EBITDA impacts multiples, so that's very clear. We look at optimizing this across processes, and I can give an example. One of our companies, which is into ice cream manufacturing, simple thing we did is reverse auctions, where we reduce the procurement cost by 20%. So we look at every aspect of cost, where all we could optimize them, make sure that they are most efficient. And last but not the least, we also look at the technology maturity. We benchmark their technology adoption, their AI adoption, digital adoption, how well set they are in terms of adopting technology, benchmark it with industry peers, help them to chart out a roadmap which would compare with the best, help them to implement, choose the right partners. So as a PE firm, as I mentioned before, capital investing is just commodity. We also help the business to bring in the right talent, the right interventions, and at the same time, not necessarily hoist ourselves there, but blend with the portfolio company to help them to achieve the growth.
Yeah, thank you.
Maybe I'll add a few things to what he said, right, Mani said. If you look at, say, the companies that we work with, now different companies have different investing theses. In some cases, if it's a manufacturing firm, I think the focus is on improving or increasing manufacturing capacity. Can we bring in capital, of course, but can we help them set up a greenfield manufacturing plant? If it's a sales and distribution business, it's about can we help them expand beyond, say, South India to 10 states in North India? Can we help them with the distribution architecture? Can we help them set up the distribution? Can we help them set up the field operations and all that, right? So typically, we put our support in 3 buckets: revenue acceleration, and that could be distribution expansion, geographical expansion, line of business expansion, capacity expansion. Second is optimization of fuel for growth. Can we bring in processes, technology, AI, other mechanisms to drive cost efficiencies, right? It could be procurement efficiency, it could be manufacturing efficiency. The third thing is essentially around risk mitigation, right? Because especially in financial services, compliance and risk is such a big thing, right? So broadly, our engagement with the companies and the programs we run with the companies for value creation are in these 3 broad buckets. Of course, underpinning all this is the right talent, which has to be there.
I'll just add, one more point is we don't, and I'm sure I can speak for the others too, we don't have one formula which applies to all the portfolio companies. Broadly, it is tailor-made, it is bespoke for a portfolio company, and it's not necessary we involve ourselves heavily into each and every portfolio company. Some companies are low touch, where we are very confident that they have got the leadership team, they have the market, they have the product, so we barely involve ourselves there. There are some companies which are very high touch, where we start right from recruiting, like one of the portfolio companies from a tech perspective, I helped recruiting the CTO and the entire team, and they are fully up and running now, comparable with the best. So it depends on portfolio to portfolio company, but it's very well aligned right at the beginning, the interventions that need to be in place.
Perfect. So as you come from deep tech side, right? So maybe you can, and there's a lot of community on tech side and looking for partnership as well. So what are the interventions you do deep in tech side that may be very useful for them to have a good view on, and where you can bring some of them inside, right?
So I think if I look at financial services in itself, right, on the tech and AI side, I think in many cases, because the company we invest in are sort of have not had deep tech investments, we end up rewriting the whole stack, right? The whole lending stack in many cases is rewritten, primarily underpinned by either revenue acceleration, like I said, because we want to have better presence in the field or with the DSAs, or efficiencies, which is what we want to do in underwriting, credit, and ops, right? So in many cases, we end up rewriting the whole tech stack. In many of these cases, we end up partnering with fintechs who can bring in point solutions in that tech stack, right? Perfios, of course, is a great example. We've used Perfios in many of our portfolio companies, given the fact that it's a portfolio company. But then we have been engaged with companies like Pennant on the LMS side. We've been engaged with smaller companies on the collection side. We've been engaged with a number of AI companies which have come in and brought in point AI use cases which have helped our companies, right? So on the cybersecurity side, I think we've been engaged with many smaller companies, because we're also trying to see who is a good bet from a local ecosystem perspective, right? So typically we end up bringing in a strong CTO and a strong engineering team, and once we have that in place, then it's about what is it that will drive revenue acceleration, what is it that will drive cost efficiencies or risk mitigation, and then a number of partners we look at, both large and small, to bring that to play.
Perfect. Maybe extension of that question to you, because you get it deeply involved. So you can give us guidance on both pluses and minuses, where you've seen great experience, you feel something could have been done better, because it's an experiential by nature, right? You intervene, you can be right, you may be wrong. The investee founders or maybe the previous investor may not be happy, right? You can always have multiple. So if two Ps are putting their legs in, then how do you adjust? So a quick view on Mahesh, from your side, how this whole process will work, and how, let's say, some of them, when they're coming to you, should get used to working with PEs and what they should be ready with?
The first piece of advice is, I think, to treat the investor as an additional business development or support function. Okay, most people see us as, trying to send some spies into the business. That's not really what we are attempting to do, right? So I think the minute leaders stop being defensive, I think they'll gain a lot from the private equity folks, because think about it, right? We see 1,000 deals a year. That's on average maybe 3 to 4 deals in a day. So we are sitting on a vantage position where we have seen businesses multiple times. The same business comes to us. I think there are lots of businesses that we see in the life cycle of what we have been doing 5, 6 times. So we've seen the pains, the scale up, the success, the failures. So, and just like you, we're also learning. So I won't say that, we have all the answers. But I think you can benefit from somebody sitting 30,000 feet. And it's like a movie. We see this movie being played time and again, and except that our hands are tied, we can't do anything about it, okay? We know 4 quarters out, this is going to happen. And I can't tell you how frustrating it is that the same movie plays out, right? Now, whether we say nice things about a portfolio company or no, they might come true, might not come true, but everything that we fear about a portfolio company sitting on the outside, comes true. Okay. So I think one way for all of you is to actually use them as a sounding board. You don't have to always agree with them, but use the investor that you have to the fullest advantage. They can help you in business development. They can help you in giving a perspective that might be different from what you're doing, not necessarily the right perspective. If there is a difference of opinion between you and the investor in an operating decision, it's quite likely that maybe you can take that decision. But I can tell you, if there is a difference of opinion between you and the investor on a financial decision, I would recommend that 90% of the time they are right, because they come with a very different perspective on how capital is allocated and used. So I think those are important ones. So reach out, ask for help. Don't treat them as somebody who's trying to meddle in your affairs. And I think if you can establish that equation, that you will reach out for support when needed. And I think if that equilibrium is established, and I think good companies are able to do that, I think it's a great outcome for companies there. So I think that's how I would put it. I mean, I can repeat a lot of what they said, but that's how I would, request you to look at it.
No, I would echo that, right? Echo that sentiment. I think some of the companies which have leveraged investors well are people who have used them to open doors, right? I think given the fact that PEs have been in that ecosystem for such a long time, they are in a position to open doors for other portfolio companies, but also open doors from past connections. So your investor Rolodex, I think, is one of the most important things that you can leverage, right? And of course, I echo the point on strategic decisions. They have seen this multiple times, so they will bring in a perspective which you may not agree with, but is worth considering definitely, right? So use them as a sounding board, use them as a guide, but also use them as a business development team, because it can open so many doors. And the other thing is PE has access to a network of advisors and experts. It's not just us, right, or the PE employees. It's a larger network of advisors and experts that we have access to, who can bring in significant value to you as a company in which somebody's invested.
No, I've seen some of the advisors, rock solid advisors you guys have.
I can't amplify enough what my colleagues have just said, but let's say if a fintech is looking for capital, I think 2 things are very important, I would say. One is you should be very clear, why are you looking for a capital? I think that should be very, very important. I presume that your product is very robust, your market growth is always there. And if those 2 things are met, you will have a lot of PEs approaching you. And when you want to choose between a PEs, it's not just capital. As I said, capital is just commodity. Look at, first and foremost, whether you are able to trust the PE. Because having a trusting relationship is very important when you look at a PE from an investment perspective. Second aspect would be, and what Suhas just said is the value add. Europeans have a range of industry leaders in their operating advising team. They have a large operating team. So if you're convinced that a particular PE would be able to add value based on your product or based on your market, that should play a big role rather than just the capital.
No problem. Maybe we'll have one more question, last question. Just one last question from the ecosystem. Yeah. Anybody has any question for the forum here? Yeah. Maybe some of you may be on the stage of building as well, right? So PE, when you come looking for a check of $50 million, and when you go, I think I can't go to them for any funding because they will say, "Kya kar raha hai?" You must scale up, right? But I think with this we close. We wanted to expose you to the PE ecosystem. And I think I'm so happy to have them all here. They're hands-on operators. They go through thesis really well. They help the companies, and their companies have done well, right? I think all their companies have done significantly better than the ecosystem. So I think you have the right guys to advise. So thank you for joining. This is the first time I am having purely a PE-focused sessions, and your intervention and guidance are very useful. Thank you, thank you, thank you. Okay, thank you for joining. Thank you, Mani. I always got the wrong direction, so I keep attempting. Thank you for joining with me. Thank you. So I don't know how MC speaks, so maybe a big round of applause to these folks here, right? They came across and just guided us. Thank you.
Thank you so much. That's a token of love and appreciation from our side. Thank you so much for the speakers.
Mahesh, you have been always supporting us. Thank you. Maybe we can.